Ladies and gentlemen, thank you for standing by and welcome to the Resimac Group FY21 Investor Call. At this time, all participants will be in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to queue for a question, you will need to press 0 followed by 1 on your telephone keypad. I would now like to hand the conference over to your speakers today, Mr. Scott McWilliam, Chief Executive Officer, and Jason Azzopardi, Chief Financial Officer. Please go ahead, gentlemen, and thank you.
Thanks, James. Good morning. It's my pleasure to welcome you to Resimac's Results Investor Conference Call for the year ended 30 June 21. My name is Scott McWilliam, CEO of Resimac, and with me is Jason Azzopardi, our CFO. We'll be talking to the investor presentation lodged with the ASX this morning and welcome any questions at the end of our presentation. If I think back 12 months ago, even 6 months ago, I don't believe anyone could have anticipated that a large portion of our population would be in lockdown again today. My heart goes out to everyone who's been affected by this virus. Supporting our impacted customers through these difficult times continues to be a key focus for the business. However, notwithstanding the trials and tribulations brought about by COVID-19 and other adverse events, the Resimac Group has had a great year. We were pleased and humbled to be awarded Non-Bank of the Year at the 2020 Australian Mortgage Awards in recognition of the compelling brand proposition we offer to our third-party distribution partners and also our customers. Resimac Group has been well placed to service the increasingly strong residential property market demand through the strength of our multi-channel distribution model, which now includes 2 new brands that we launched in FY21. Our new direct-to-consumer channel brand, homeloans.com.au, as well as Resimac Asset Finance, which enables us to offer a full suite of lending products to customers and commercial borrowers. Looking now at slide 2 of the investor presentation, I wanted to highlight the 4 brands within the Resimac Group. Resimac Australia had 2.2 times assets under management growth in FY21, an increase of 12% on the prior year. This was fueled by the popularity of our competitive specialist loan products, which saw $1.4 billion worth of growth in settlements, an increase of 14% on the prior year. We also issued our lowest margin prime and specialist RMBS transactions since the GFC, reflecting strong investor demand for our mortgage-backed securities. Homeloans.com.au launched in September 20 and has contributed to the growth of our direct consumer assets under management, which increased by 10% to $1.9 billion. The lower cost of funds from prime loans has supported our aggressive growth strategy with strong lead generation and driving an effective cost per settlement and a market-leading front-end technology, providing customers with a seamless online application process. Resimac Asset Finance launched early in the calendar year off the back of our 100% acquisition of IA Group. We launched the new brand to the broker channel in April with strong support from our broker partners. This was followed by the launch of our new online direct-to-consumer channel. By restructuring the business's warehouse facilities, we have been able to reduce the cost of funds, enabling us to offer competitive loan products across consumer and commercial finance. Over in New Zealand, our Resimac brand continues to go from strength to strength, reporting $405 million in settlements in FY21, up 81% on the prior year. Our securitisation program in New Zealand follows the same trend of Australia, with our RMBS prime deals issued at materially lower senior margins compared to previous years. Furthermore, the new origination system launched in August paved the way for a faster and more streamlined loan processing for brokers in New Zealand.
Can I please ask everyone to turn to slide 4, where I'll provide an overview of our performance. In FY21, the group generated a statutory profit after tax of $107.6 million, up 92% compared to FY20. To provide the market with a true underlying recurring profit of the business, we normalise our profit where we receive one-off income items unlikely to be repeated in future periods. The normalised profit after tax of $104 million excludes the fair value gain on our equity investments. This profit increase is underpinned by a 29% increase in net interest income to $242.7 million, driven by a combination of home loan assets under management increasing 11% and home loan net interest margin increasing 17 basis points to 207 basis points. The higher net interest income, combined with our continued cost discipline, resulted in a significantly lower cost-to-income ratio of 32.1% for the year, a decrease of 580 basis points. I'm particularly pleased we continue to optimise our use of capital, with our return on equity at an industry high level of 36.9%, an increase of 1,140 basis points. As a result, we have increased the FY21 final dividend to 4 cents, bringing the full year fully franked final dividend to 6.4 cents, a 113% increase on FY20. Finally, moving to slide 5, I wanted to call out our operating expenses and loan impairment expense. Firstly, operating expenses increased $8.5 million or 14% compared to FY20. As I outlined at half year, our core banking replacement project is well advanced, with $7.8 million of costs incurred in FY21. The cost of this project has been fully expensed in the profit and loss statement. We expect a further $4 million of costs to be incurred in FY22, specifically related to this project. Secondly, loan impairment expense of $2.7 million decreased 88% compared to FY20. You will recall last year we raised a COVID overlay of $16.4 million. This overlay is now released and all loans credit risk are assessed individually within our expected credit loss model and will remain so going forward. We remain conservative on the potential credit risk on loans currently or previously in hardship that have resumed payments. The movements in our collective provision are summarised in the table on slide 13.
Thanks, Jase. Moving on to slide 8. I'm pleased to report our home loan business and growth trajectory continues, with Resimac setting a record home loan settlements of $4.8 billion, up 3% compared to FY20. Most pleasing is the momentum we built in the second half, settling $2.7 billion, an increase of 25% compared to the first half. This growth is built on the strength of our broker and direct brands in both Australia and New Zealand. The home loan market competition is fierce. Therefore, I'm pleased we continue to demonstrate the ability to increase assets under management at a multiple of system. Our home loan portfolio increased 11% to $13.8 billion across all products and channels. Once again, the second half momentum is evident, with annualised AUM growth in the second half of 14% compared to 8% in the first half. Finally, our treasury function continues to deliver outstanding results. The second half featured record low senior margins on our RMBS issuance, with our high-quality portfolio and origination strategy resonating well with investors globally. As reported to the market on Friday, we priced a $1 billion prime RMBS at levels not seen since before the GFC, including 3-year notes pricing at bills plus 68 basis points. These lower cost of funds allow us to aggressively target product segments where we believe we can take market share. Our cost of funds will continue to benefit into FY22 and beyond from these lower RMBS margins. As mentioned earlier, we are pleased to report the board has declared a fully franked final dividend of 4 cents per share, resulting in a total dividend for FY21 of 6.4 cents per share. I'll now quickly touch on our growth strategy before moving on to questions. So I can ask you please to move to slide 16. Our mission is to create a digitally enabled non-bank lender, providing innovative, competitive and accessible lending solutions to more homeowners, consumers, businesses in Australia and New Zealand. Our Resimac branded home loan businesses in Australia and New Zealand are designed to offer a broad suite of products with flexible lending solutions aimed at a wider audience, facilitated predominantly through third-party brokers. This is our largest channel and largest opportunity measured by AUM, and a market and a strategy we've been refining and executing on for many, many years. We built this business on the promise of superior service to brokers and customers, and that promise remains unchanged. Homeloans.com.au is our new online direct-to-consumer brand, servicing a growing audience who prefer to engage online and directly. We believe this market will continue to grow as customers become more and more comfortable transacting online. It is a customer-led, digitally enabled, low touch points channel targeted at a specific audience. The growth of this channel is a strategic priority for the group. Resimac Asset Finance enables us to service what we believe is an underserviced market. It is a logical and adjacent opportunity for the business to offer new products to new audiences, leveraging off our existing funding program and distribution platform. Consistent with our home loan strategy, a strong digital experience will underpin the delivery and service proposition across asset finance. Finally, our strategy is to continue to grow our assets under management at a multiple system. We believe our current investment in digital transformation, combined with the growth of our brand across brokers and also the direct channel in Australia and New Zealand, position us well to settle at least $8 billion in home loans and $1 billion in asset finance in FY24. I'll now hand it back to you for further questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. You may register a question by pressing 01 on your telephone keypad and wait for your name to be announced. That's 01 to register, and if you do wish to cancel, please press 02. Our first question comes from John Hind. John, your line is open.
Oh, good morning, Scott and Jason. Congratulations on a good result, and thanks for taking my question.
John?
Great. If we could perhaps just touch on the outlook for your NIM. The second half was down a little bit. Could you perhaps help us understand that a little bit better, and perhaps how much of a benefit do you expect the recent RMBS issuances that have been done at quite attractive rates, how much do you expect that to impact your NIM in 22 and beyond?
Yeah, thanks for the question. Look, I think the way to look at NIM is in two factors. One is the home loan pricing. Now, clearly, we are seeing very, very competitive pricing on new business in the market, and that is continuing. And there's absolute pressure. We're not immune to that pressure on yields. The yield factor in FY22 will largely be dependent on backbook runoff. We are seeing a lot of competition in the market, and we are seeing when that backbook runs off, it can be a hit on our yield. Obviously, our hedge to that is the amount of non-specialist settlements that we can originate in FY22. So we do expect yield to continue to decline in FY22, but we think that we're going to hit the bottom in FY22. In terms of cost of funds, I've tried to best demonstrate the benefit of RMBS issuance on slide 10. And what I've got on that chart there is how much we've originated in RMBS in each year and what the margins were in each year for those RMBS. Now, most of our RMBS deals, bar a few exceptions, are 4-year deals. So that allows you to start projecting about what's turning out on our RMBS and what benefit we're getting from the new RMBS. In summary, we're going to get the benefit from these low margin RMBS for the next 4 years. And the longer we continue at these low margins that we've been able to originate in the second half, our blended cost of funds is going to continue to benefit from that.
Great. Thanks very much. And just two more from me. With the ABS business, conscious that you probably don't want to discuss the product publicly just yet, but I mean, how receptive have the brokers network been to date? And can you perhaps give us some colour on the book in the second half? I think it was about 80 mil in the first half. I mean, were you able to sort of drive that business this period? And I guess then with the qualitative statements around the targets you've got for $1 billion by FY24.
Yeah. So you're right. That's right. So I'll go back to the first piece is, we are seeing month-on-month growth in settlements through that channel, and which obviously is encouraging, albeit we haven't fully launched ourselves to all of the distribution yet, because it's important that we've got the process and the technology right, to take advantage of that opportunity that I touched on earlier, where we do believe it's an underserviced market. So our investment in technology, within asset finance is pretty similar to the way that we think about the investment in technology and digitalisation within the home loans business. We will be prepared, the business will be prepared, to have production to support, more than $1 billion of settlements in a year, by FY24. And so, we're encouraged by just, albeit we're coming off a low base, we're obviously doubling or tripling the book. That's the way we kind of think of it, and that is likely to happen for the next couple of years, because we are coming off a low base, and we believe those targets that we've set, are very realistic.
Great. And just one more on that guidance slide. Sorry.
And did you touch on quality? I may have missed that piece.
On quality? Sorry, that was more quantitative. So I was talking about quantitative or qualitative. Just one more on that guidance slide. It's, they're pretty aggressive targets. How do you plan to get there, and how much, when you step back and you think about the environment you're playing in, how much is perhaps incumbents not playing as much in your space and pulling back, and how much is Resimac taking share?
Look, I think, as we grow and continue to grow AUM, at a multiple of systems, then we are obviously taking, market share. But, when we step back and have a look at that kind of number, when we kind of, forecasting out of what are the targets we set ourselves, and how we're setting up the business today to give ourselves the best chance to hit those targets is, when you break them down into monthly settlements and you think about the size of system, they're still not big numbers. It is a $400 billion a year home loans market. So when we're making statements that we believe, with the service proposition and the technology to support that, we're looking to take, more than $8 billion of that, it gives you a lot of comfort, because I wouldn't call them overly aggressive. And the same to be said for asset finance as well. It is a very, very large market. And, we believe there is an opportunity for us to, in the near term, and I'll call 3 years the near term, to take, 1 or 2% of that market. So when you bring it back to monthly settlements and you look at our business and the different channels and brands that we have, when we think about them in isolation, we believe that they're very achievable.
Great. Thanks very much, guys. I'll jump back in the queue.
You're welcome.
Thank you. Our next question is from Tim Lawson. Tim, your line is open.
Hey guys, thanks for taking my question. Really just almost a follow-up to the discussion you've been having already, but in terms of the core system, you've called out the investment. How important is that in being able to sort of do the volumes you're talking about?
So in terms of doing the volumes, Tim, what we're rolling out in terms of our new origination system, which we've actually just rolled out in New Zealand, and we will be rolling out in Australia, staggered rollout in Australia between now and probably the end of October. It's that particular system that probably more supports production. It's that particular system that allows us to find scalability, when thinking about settlements. The core system that you touched on is probably more important when we're thinking about user experience, because it very much then supports the back-end experience with our customers when we're thinking about the weighted average life of our customer, which is obviously extremely important, because it's that particular system that also is supporting, that banking experience and that mobile app experience that we're looking to roll out in New Zealand and in Australia in the near term. So the origination system, which we've just rolled out in New Zealand and just about to roll out in Australia, is more about helping us in supporting production and also reducing turnaround times and driving scalability. The second piece is more about UX.
Yeah. Okay. And when that expense that's currently going through the P&L is done, does that just disappear, or do that get those costs remain in some other way in the business?
It's a good question. So we think our investment in process and digital, we'd like it to continue. This is a large transformational project. It would be definitely the highest cost one-off project. We want to continue to invest to build scale into this business. We have very, very large growth ambitions. So the honest answer is we don't have that mapped out what we do post the transformation project because it is so large for us. But we want to continue to invest in this business long term and keep positioning it for future growth. So I don't want to commit and say definitely yes, because there will be an element of spend. Whether it's the same amount of that project, it's to be determined.
Okay, thank you.
So Tim, we don't have any. There's no plans for us to go through a project of this size in the near term. I've been told you only replace your core banking system once, in your career. But what we will be doing going forward is, I don't think you actually ever invest. You ever stop investing in technology and driving kind of those digital outcomes, which is all around speed, flexibility, and user experience. What we will do going forward is we'll continue to build applications on top of, the foundation, which is that core banking system that we are in the process of replacing. So we won't be looking at projects of this size in terms of individual project size from a dollar perspective, nor from a time period perspective, but we will continue to invest, in and around that platform, especially from an application perspective, to continue to improve that user experience, which benefits us internally from an efficiency perspective, but obviously very much driven by the user experience at the street level.
Thank you.
Once again, ladies and gentlemen, if you would like to ask a question, please press 01. Our next question is from Michael Kent. Michael, your line is open.
Good morning, guys. Fantastic result. I note that you've increased profit like 80-90% for the last 2 years. How do you think that the market should be, or maybe internally, how do you measure your performance? Is it a combination of return on equity, profit growth? I mean, I'm just curious as to what sort of internal measures you have for measuring performance and what your objectives might be in that regard.
Look, good question, because internally we don't necessarily spend a lot of time looking at the numbers that drop out of the bottom of achieving our KPIs. So the numbers that we do look at internally are around cost to income ratios. I think that's kind of a demonstration of whether the business is obviously growing and looking for efficiencies within the process and the system. Also demonstrates the cost discipline. And it's sometimes easier during strong times for costs to build some back in those costs, and that's obviously something that we're very focused on, and so is the board. And the other piece is return on equity. We run a capital efficient model. We'll continue to run a capital efficient model. And I think that's they're probably the two measures that we talk about quite a bit internally. And the other piece is, and which is probably becoming a growing KPI when we think about internal conversations, which should then just result in greater settlements, greater AUM, and a growing profit, is customer insights. We are very much focused on moving towards more of a data-driven organisation. To build out on the intel that we have today. Things around predictive analysis and things like that is something we spend a lot of time talking about. So that The measure of customer experience is probably a KPI internally that we talk about quite a bit. So I'd say across those three measures, they probably get 80% of the airtime.
Okay, thanks. What about dividends? Is there much discussion about that internally? I notice you've got pretty big store of franking credits there, and it's great to see the increased dividend, but you probably could increase your payout ratio from 25% and still have enough room for growth, couldn't you?
Yeah, look, we're mindful of supporting the organisation or investing back in the organisation for further growth. We still see ourselves as a growth stock more than a yield stock, and I believe with the improvement in our payout ratio, albeit still modest, in that kind of 20 to 30% range, we recognise the importance of obviously delivering those profits back to shareholders. But investing internally on technology and investing in our funding program is critical to our growth, and we will continue to support what I'd say is a modest payout ratio, and in time we'll move towards what we believe will be a healthy blend between a growth stock and a yield stock.
Yeah, thanks, guys.
I think
good work.
Just to add to that, we've always run a very capital efficient business, and which is clear in the ROE. We're talking about some ambitious growth targets, and we do need capital for that. Asset finance requires a bit more capital than home loans in the funding structures, as Scott's alluded to. So we are reinvesting capital either into the projects that we're doing or into our funding programs, which will deliver long-term benefits to shareholders. We've got the track record where we've had efficient use of capital up to now, and we'll continue to do that. We're not sitting on piles of cash and not using it efficiently, I can assure you.
Thanks.
Thank you. Our next question is from Andrew Tan. Andrew, your line is open.
G'day, Scott. G'day, Jason. Thanks for the questions, and well done, and thanks for your efforts in managing the business. Just a question about the comment about warehouse funding. I guess the margin of that was elevated during COVID. So is there a benefit from that normalising, I guess, going forward?
Yeah, so you generally do. So your warehouse pricing or margins would generally follow market pricing. So, obviously, the first round of COVID, or let's say, 12 months ago, where credit spreads moved out, so does warehouse pricing. But obviously, as credit spreads have moved in the term markets, well, then so will warehouse pricing. On average, and I'm not saying it happens, it's correct every day of the week, but generally your warehouse pricing will trade at a slight premium to your term pricing. And the reason for that is, by definition, it is a warehouse. The objective is to move from that warehouse into the term market. So you can understand that it needs to be more attractive to move into the term market to support that process. But the two generally move together. There might be a slight lag between warehouse pricing to term market, but they're generally priced pretty similarly.
Okay, so
and if should warehouse pricing stay where it is today for the whole of FY22, it would be a tailwind to NIM compared to 21. The average warehouse pricing in 20 remains where it is today will be lower than 21.
Yeah, and how do we look at that? I guess, is it similar to that RMBS chart you put in that slide 10?
Well, it's not. So to Scott's point, it prices about at a small premium to where recent pricing is. The thing is, every time we do an RMBS, we can't immediately go back to all our warehouse providers and get a reprice. We only got 2 months ago. So the new issuance is assisting us with warehouse pricing, but some of the offshore warehouses may be 6 months renewals, and we might have to wait a 4-month period before we can to reprice that. So what it is the RMBS pricing is a great benchmark for us to allow us to negotiate with our variety of warehouse providers, and we're just negotiate and working hard on every basis point on that regularly. Okay, so if I were out of a guess, it's a 5 to 10 bit tailwind, in terms of warehouse funding. Is that a appropriate guess? I don't want to pin down on a basis point number. I'd rather look at total cost of funds. I might just take that away and come back to you, Andrew. Okay. But I guess it was a headwind of 4 bips in FY21, so it should be a tailwind of 4 bips at least in FY22. Yeah. And to split that, first half 21 was a headwind of 7 bips and was a tailwind of 2 bips in the second half. So we would expect that tailwind, especially with 3 RMBS terming out in FY22, new originations coming on, and a full year of lower warehouse costs. We expect funding costs to be a tailwind in FY22, but as I noted earlier, yields will be a headwind. Okay. With the runoff of the back book, what's driving that? Is it early repayments of borrowers, or is it refinance activity? What's the key driver of that back book runoff? Yeah, look, it's both, and we're seeing it across the market with our peers, and it's probably ramped up in the last quarter. Be fair to say. Look, there's a lot of people looking at their personal balance sheets. There's a variety of factors that we're seeing. So, we're doing everything we can. We're doing everything we can, but the reality is there's a lot of back book pricing that's a lot higher than front book, and people are looking at that and making a change, and we're doing everything to make sure that change is to stay with us on that home loan journey. But sometimes it's difficult for us to retain if we find out too late. So look, that's a real big focus for the business at the moment, is how can we keep originating at the levels we are and increasing that, but also retaining a loan is as important as originating one. And we've got a number of initiatives in place to try and reduce that. Okay, and just jumping to the Resimac asset finance, is it loss-making at the moment? Or are you absorbing a loss within the business as you start that business up?
No. We bought a profitable business. It's still a profitable business. But Andrew, like growing any book, it's a slow start as you're investing in the program, you're investing in technology, you're investing in staff, and then before you find that kind of hockey stick, effects 2 to 3 years out. But no, it's a profit-making business today, and obviously we have high hopes, in terms of its contribution to the overall group, in 3 to 5 years' time, and it also helps us when we think about things like NIM that you're just talking about. It helps you kind of balance your NIM trade-off, albeit it's all risk adjusted, but it's a market we're keen to grow in, and we see great opportunity in. And the performance of that book, despite the fact it's still relatively small, has been exceptional.
Okay, great. And just lastly, about the IT costs, I just wanted to understand whether is that 4 mil in FY22 incremental to 7.8, or is it really a net reduction of 3.8 mil that's going to be expensed?
No, so the total project will be approximately 12 mil. So it's 4 mil of OPEX in FY22, not 11.8 mil. That makes sense. Okay, that's what you're asking, right? Yeah, it's a one-off expense. Okay, got it. Yeah, 7.8 this year, 4 million next year on that project. Okay, great. Thanks very much. Cheers, Andrew.
Thanks, Andrew.
Once again, ladies and gentlemen, if you would like to ask a question, please press 01 on your telephone and wait for your name to be announced. Our next question is from Stanley from Bell Potter. Stanley, your line is open.
Hi, Scott and Jason. I'm assuming that's me. But, yeah, look, congrats on a strong result. Look, just a quick question from me just on settlements in the second half. There's obviously a reasonably big uptick. Just wanted to understand the profile of that going into FY22.
Yeah. So obviously strong momentum, in the second half. If I break that into quarters, a strong fourth quarter, with obviously healthy momentum running into FY22. So that answers your question.
What was the main driver of that? Like, what caused the uptick in the fourth quarter?
We were pretty targeted, and I think we kind of made some statements as well that we're going to be fairly targeted, especially in relation to the near prime market where we saw opportunity, especially where we could see credit spreads heading on our specialist RMBS deals. So it was very much supported by quite a targeted campaign around the near prime market, and to test that market as well for depth and quality. That was probably the main driver behind it, and well supported by our broker community.
Okay. So what was the split between the third and fourth quarter?
Don't have the split in front of me, Steve, but the fourth quarter was stronger than the third quarter.
Okay. And should we be looking at it as if it's sort of a run rate of the fourth quarter going into the first half? Obviously it's difficult to look that far forward, but would that be your expectation?
Yeah, I think more into the first quarter of this year, Steve. I think that's kind of fair, but obviously we're sitting here today, we're entering what week of lockdown are we in New South Wales? 10th week of lockdown, and obviously Victoria, looks like, they're going to be in it for quite some time. So, yes, I think that's a fair assumption to make getting into the first quarter with a bit of uncertainty around that second quarter, which should be no surprise.
Yep. Okay, great. No, that's all from me. And yeah, look, congrats again on a fantastic result.
Thank you. Thanks, Steve.
We appear to have no further questions at this time. I'd like to turn back to our presenters.
Thank you, everybody. Appreciate you taking an hour out of your day to listen to our results. And we look forward to making further announcements, especially in relation to what we're doing on our asset finance business for now and the end of the year. We're looking forward to executing on our core banking platform within the next 6 months, which again will benefit the businesses, but also our borrowers and our broker partners. And take care. Thank you very much.
Ladies and gentlemen, that does conclude today's conference. Thank you all for attending, and you may disconnect your lines.